Viewers at home, you are welcome to my presentation on royalty accounts. Royalty accounts. In this presentation, I will examine the following. Number one, meaning of royalty. Meaning of royalty. 2. Forms of royalty. 3. Terminologies used in royalty account. 4. I will as well examine the accounting entries in the books of the lessee, I will as well give a practical work example. If you are just coming across this YouTube channel for the first time, or if you have not subscribed in the past, please don't forget to click the red subscribe button and also turn on the notification bell icon so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you and God bless you. Royalty account. A person who owns a legal right may allow another person to exercise that right for consideration. A person who owns a legal right may allow another person to exercise that right for consideration. That consideration paid or payable to the owner of the right is called royalty. Royalty is the consideration paid or payable to the owner of an asset in exchange for the right to use it. The consideration paid or payable to the owner of an asset in exchange for the right to use it is said to be the royalty. Different forms of royalty exist. Forms of royalty. Forms of royalty. Number one, we want to consider the copyright. Copyright. Copyright is the right of an author over the work or material written by him. The right of an author. The right of an author over the material or work written by him is said to be the copyright. Number two, we have the patent right. Patent right. Patent right is the right of an investor. The right of an investor over the device invented by him. The right of an investor over the device invented by him is said to be the patent right. Number three is the mineral right. Mineral rights. Mineral right is the right of the landlord. The right of the landlord over the mineral resources contained within his land. Mineral right is the right of the landlord over the mineral resources contained within his land. That is the mineral right. So, these are different forms of royalty. Don't forget, I've told you that royalty is the consideration payable to the owner of an asset in exchange for the right to use it. So, we want to look at the different terminologies used in royalty. Definition of terms. Definition of terms. Number one term we are going to look at is the landlord, or grantor, or lessor. Landlord or grantor or the lessor. This is the owner of the legal right. The landlord or the grantor or the lessor is the owner of the legal right. The owner of that asset is said to be the landlord. The owner of the legal right is said to be the landlord. E.g., the author owns a legal right over the work or material written by him. The right of an author over the material written by him, we said that is copyright. Therefore, where an author owns a copyright on the material written by him, that author is the landlord. That author is the grantor. That author is the lessor. Number 2, we have the tenant. Tenant or the grantee. Grantee or the lessee. The tenant or the grantee or the lessee. This is the person allowed by the owner to enjoy or exercise the right. The person allowed by the owner. The person allowed by the landlord. The person allowed by the lessor to enjoy or exercise the right. The person allowed by the owner to enjoy or exercise the right is said to be the tenant or the grantee or the lessee. In the above example, the publishing house is the lessee. The publishing house was granted the right to exercise the publishing. So that publishing house is the lessee. That is. Then number 3 is actual royalty. Actual royalty. Actual royalty is the amount of royalty calculated on the actual level of activity or utilization. The amount of royalty calculated on the actual level of activity is said to be the actual royalty. To calculate the actual royalty, we have actual quantity or actual output times amount of royalty payable per unit of output. Royalty payable per unit of output. When you multiply by the actual quantity, it will give you the actual royalty. Number 4, we have the minimum rent. Minimum rent or dead rent. Minimum rent or dead rent. This is the minimum amount payable to the owner, the minimum amount payable to the landlord, irrespective of the quantity produced. The minimum amount payable to the landlord, irrespective of the quantity produced or utilization, is said to be the minimum rent. I want you to know that landlord can receive above the minimum rent. That is, the lessee may pay above the minimum rent to the landlord, but cannot pay less than the minimum rent. Where what the lessee produces is not up to the minimum rent, then that means the lessee will add money from his or her personal purse to it and pay the minimum rent to the landlord. The landlord cannot receive below the minimum rent, but the landlord can receive above the minimum rent. Supposing the utilization or what was produced by the lessee, maybe it is $1,000. This is what was produced by the lessee. But the minimum rent, if the minimum rent is 1,200, that means the lessee will need to add additional 200 to the 1,000 produced by him in order to pay 1,200 to the landlord. That means the landlord cannot receive below the minimum rent, but the landlord can receive above the minimum rent. Number 5, we have short workings. Short workings. Short workings is the excess of the minimum rent over the actual royalty. Excess of the minimum rent over the actual royalty is said to be the short workings. The amount by which the minimum rent exceeds the actual royalty is said to be the short workings. To calculate your short workings, we have the minimum rent and minimum rent minus actual royalty. That will give us the short workings. Where the minimum rent is 1,200 and the actual royalty is 1,000, that means there is a short workings of $200. If the minimum rent is 1,200 and the actual royalty is 1,000, then that means there is a short workings of $200. So we have the right to recoup or to recover the short workings. Right to recoup the short workings. I want to know that short workings can be recovered in 2 ways. There are 2 ways in which short workings may be recovered. Now we have short workings recovered with limitations of time and the short workings recovered without the limitation of time. I've told you that there are 2 ways through which the excess workings can be recovered. There are 2 ways through which or in which the short workings can be recovered. We have short workings recovered without the limitation of time. Meaning that in this case, the lessee can recover the short workings anytime there is a surplus in the future. The lessee can recover the short workings anytime there is surplus in the future. That is short workings recovered without the limitation of time. The second one is short workings recovered with limitation of time. In this case, there is a time limit in which the short workings can be recovered. This is where the lessee is given the time limit to recover the short workings. When there is surplus in the future, the lessee is given the time limit to recover the short workings anytime when there is a surplus in future. Meaning that any short workings that cannot be recovered within that time limit as stipulated cannot be recovered again. So there is a time limit to recover the short workings. Short workings. So there is a time limit to recover it in the future when there is a surplus. That is short workings recovered with limitation of time. So then these short workings, the amount recovered by the lessee from the short workings is short workings recouped. Short workings recouped or short workings recovered. No, your short workings, this is short workings recoverable in the book of the lessee. The amount recovered is the short workings recouped. While the one not recovered is the short workings lapse. Short workings lapse or short workings irrecoverable. Short workings lapse or short workings irrecoverable. The short workings that cannot be recovered will be written off by the lessee in his statement of profit or loss. You are going to write it off as a loss. The one not recovered should be written off as a loss by the lessee in the statement of profit or loss. Where it is a loss, that means it will be debited to the statement of profit or loss, since it is a loss, in order to write it off. So, having considered the terminologies used in royalties account, I therefore want to examine the account you will need to prepare in royalty accounts. So, accounts required. Accounts required. Number one, we have the landlord account. Landlord accounts required in the books of the lessee. In the books of the lessee. The following accounts shall be prepared in the books of the lessee. Number one, we have the landlord account. Landlord account. Remember, I've told you that landlord can also be called the lessor. Lessor account. You know, landlord is the owner of the legal right, and the lessee is expected to pay the royalty to the landlord. So in that case, since landlord is a creditor to the lessee, therefore the landlord account is a liability account to the lessee. This is a liability account. Remember, liability will have a credit balance. So this is a liability account to the lessee, since the lessee is expected to pay the royalty to the landlord. Number two, we have the royalty payable account. Royalty payable account. The lessee is expected to make the payment to the landlord. So, since the lessee is expected to pay that royalty to the landlord, this account is an expenses to the lessee. This is an expenses account. The third one is the short workings recoverable account. Short workings recoverable account. This is an asset account. It's an asset to the lessee. Short workings recoverable account is an asset to the lessee. So these are the accounts you will need to prepare in the books of the lessee. Now we want to examine or consider the accounting entries. Accounting entries in the books of the lessee. In the books of the lessee. Everything must be in line with the principles of double entry. All your entries must be made in line with the double entry principles. And remember the double entry principle, which states that for every debit entry, there must be a corresponding credit entry. That means you are going to treat each transaction in line with the principles of double entry. So, remember, these are the major transactions you are going to make. Number one, you are going to pay royalty. The lessee will pay royalty to the landlord. The lessee will pay royalty to the landlord. So, number one, with the actual royalty payable, no, in the books of the lessee. Number one, with the actual royalty payable. I've told you that royalty payable account is an expenses to the lessee. And being an expenses account, it will therefore receive a debit entry. So you debit royalty payable account and you credit landlord account, or you credit the lessor account with the amount of actual royalty, with the amount of actual royalty. I've told you that when you multiply the actual output or actual quantity by the royalty payable per quantity or per unit, of output. So that will give you the actual royalty. So you debit the royalty payable account. I've told you that royalty payable accounts and expenses. So you credit the landlord account. Remember, landlord is the creditor. Is a creditor to the lessee. Number 2, we have short workings account. Short workings. I've told you that short workings recoverable is an asset to the lessee. Being an asset account, it will therefore have a debit balance. Therefore, debit short workings recoverable account, short workings recoverable account, and you credit the lessor account. I've told you that the lessor is the same as the landlord, and credit the landlord account with the amount, with the excess of the minimum rent, with the excess of the minimum rent over the actual royalty. I've told you that the amount by which the minimum rent exceed the actual royalty, I said that is the short workings or short workings recoverable account. Number 3, I've told you that this short workings recoverable account will be divided into 2: the short workings recouped and the short workings lapse. Now I want to consider the short workings recouped by the lessee. Short workings recouped by the lessee. So short workings recouped by the lessee. So you debit the lessor account, that is, you debit the landlord account, and you credit the short workings recoverable account. Credit short workings recoverable account with the amount of short workings recouped. With the amount recouped. Amount recouped. Number 4, short workings lapse or short workings irrecoverable accounts. I've told you that where the lessee is given a time limit to recover its short workings, any short workings that cannot be recovered within the said period cannot be recovered again. Such amount of short workings will be written off in the statement of profit or loss, since it constitutes a loss to the lessee. So since it is a loss, you are going to debit the income statement. You debit the income statement, that is, you debit the statement of profit or loss, and you credit the short workings recoverable account. Short workings recoverable account. Remember, I told you that the short workings recoverable account, I said it will be divided into 2: the short workings recouped and the short workings lapse. So you debit the income statement with the amount of short workings lapse, and you credit the short workings recoverable account with the amount of short workings lapse. Number 5, royalty paid. Royalty paid. The amount paid, remember, everything is still in line with the double entry principles. You debit the receiver, you credit the giver. Debit the receiver, you credit the giver. The lessee pays royalty to the lessor. That means the lessor is the receiver. So you debit the lessor account. You debit the lessor or the landlord account and you credit, you know, the lessee is giving out the cash or check, so you credit the cash book with the amount of royalty paid, with the amount of royalty paid. These are the accounting entries in the books of the lessee. So I therefore want to take, before I take a work example, let's consider the table of preliminary workings. Table of preliminary workings. Before you start your posting, this table is very essential. So pre me before. So it will guide you into your workings or solution. So the first thing, you may have your year, the years in question. After your years, you have the quantity or output produced. Then you have the actual royalty, which will be royalty payable in the book of the lessee. That is where you multiply your output by the minimum amount payable per unit. So that will give you the actual royalty. Then you consider your minimum rent, or excess rent. I've told you that the amount by which this minimum rent exceeds the actual royalty. I've told you that that is the short workings recoverable. Short workings recoverable. So the short workings recoverable. So certain amount of it will be recovered. The amount to recover, you have the short workings recouped. The amount of that short workings not recovered. So we have short workings irrecoverable, or short working lapse. Then you now have the actual royalty paid. So this table is very essential. Now, example. EZIKAN holds the patent rights for a new financial accounting textbook written by him. On 1st January 2022, he granted a license to OJ Limited to manufacture and sell the books in return for a royalty of $2 per book sold, subject to a minimum payment of $140,000 payable annually on 31st December, the accounting year end of EZIKAN. Should the royalty calculated on actual quantity of books sold be less than $140,000 in any year, the shortfall could be set off against royalties in excess of the minimum within the next 2 years. Now, in this case, you are given next 2 years as a time limit to recover the short workings. That means in this case, the short workings can be recovered with limitation of time. Any short workings that cannot be recovered 2 years after its occurrence in this question cannot be recovered again. Such short workings will lapse. That is, it cannot be recovered. The quantities of books sold were as follows for the first 5 years. You are given years, you are given quantities of books sold. The first year is year 2022, and 42,000 units were sold. 2023, 76,000 units were sold. 2024, 15,000 units were sold. 2025, 60,000 units were sold. And 2026, 85,000 units were sold. The sums due to EZIKAN were all paid at the due dates. You are required to show the ledger entries in the books of OJ Limited. You have to show the ledger entries in the books of OJ Limited. Now back to the question. EZIKAN holds the patent. That means EZIKAN is the lessor. EZIKAN is the lessor. That is the landlord. EZIKAN holds the patent rights for a new financial accounting textbook written by him. On 1st of January, he granted a license to OJ Limited. That's to show that OJ Limited is the lessee. And you have to show the necessary ledger in the books of OJ Limited. That means you have to show the ledgers in the books of the lessee. Now, the solution. Now, the first thing is to prepare the preliminary workings. Preliminary workings. The first column will be for the years. And the first year is year 2022. Then we have actual quantity sold and actual royalty. Actual royalty. Back to the question. The actual quantity sold in year 2022 is given to be 42,000, 76,000 in 2023, and 58,000 in 2024. 42,000, 76,000, and 58,000. So we have 42,000, 2023, 76,000, and 2024, 58,000. 2025 and 2026. 2025 we have 60,000 and 85,000 in 2026. So 60,000 and 85,000. Now, back to the question. You were told that on 1st of January 2022, he granted a license to OJ Limited to manufacture and sell the books in return for a royalty of $2 per book sold, subject to a minimum payment of 40,000. So the royalty per book is $2. So if you have $2, 42,000 times 2, and that will give us 84,000. $84,000. Then 76,000 times 2, that gives us 152,000. Then 58,000 times 2, that gives us $116,000. Then 60,000 times 2, we have 120,000. And 85,000 times 2, that gives us 170,000. Then the next column is the minimum rent or dead rent. Minimum rent or dead rent. Back to the question. You were told, subject to a minimum payment of $140,000 payable annually on 31st December. Payable annually on 31st December. So the minimum rent is $140,000. $140,000 per annum. Payable on the 31st of December every year. So 140,000, and that is our minimum rent. The next column will be short workings. I've told you that short workings is the amount by which the minimum rent exceeds the royalty payables. The amount by which the minimum rent exceeds the royalty payable, that is the short working. That is the amount by which the actual royalty falls short of the minimum rent. Therefore, 140,000 minus 84,000, that gives us 56,000. Then this one now, if you look at this, the actual royalty exceeds the minimum rent. That means there is excess royalty. Then, in this case, you can recover certain amount from our short workings. You can recover certain amount from our short workings. So now let's have the short workings recoverable. Short workings recoverable. Remember, you were told to recover the excess workings, that is the short workings, within the next 2 years. Now, short workings recouped. 152,000 minus 140,000, that gives us 12,000. That means from the short workings of 56,000, then you can recover 12,000. See the actual reality, that is reality payable. Since it exceeds our minimum rate, then you recover 12,000 excess from our short workings of 56,000. Now, short workings lapse, that is the one that cannot be recovered. Then we now have reality paid. Reality paid. Now, 116,000 here, we have 140,000. The minimum rent exceeds the royalty payable. So that means there is a short workings of 24,000. Short workings of 24,000. Now, remember from the short workings, the first short workings of 56,000 here, you have recovered 12,000 in the year 2023 when there is excess royalty. That is when royalty payables exceed the minimum rent. So, if 12,000 is recovered from 56,000, you have 56,000 minus 12,000, then you have the excess workings of 44,000. That 44,000 can only be recovered the next 2 years after its occurrence. If you count the first year now, we have the first year after, the short workings occur in year 2022. Now, the first year after 2022, we have 2023, and the second year, 2024. That means any portion of this 56,000 that cannot be recovered in year 2024 cannot be recovered again. Therefore, since there is no excess royalty in year 2024, that means the remaining balance of 56,000 which have not been recovered will not be recovered again. That becomes short workings lapse. So we have 56,000 minus 12,000. That means the remaining 44,000 will lapse in year 2024. So you have 44,000. Now, the royalty paid now. In year 2022, I've told you that the landlord, that is the lessor, cannot receive below the minimum rent. But the lessor can receive above the minimum rent. Since the minimum rent is 140,000 and the actual royalty is 84,000, landlord cannot receive below 140,000. So the amount that will be received by the lessor, that is the landlord, in the first year, which is year 2022, will be 140,000. So actual royalty paid will be 140,000. In year 2023, there is excess here, but the deficit of the lessee in year 2022 has been recovered. That means what will be paid to the landlord will be 140,000. The remaining balance, that is the balance of 152,000, that is the amount by which it exceeds the 140,000, has been recovered, has been used to recover what the losses the lessee suffers in the first year, which is year 2022. So the amount that will be paid in year 2022 will also be 140,000. So we have 140,000. In year 2023, there is a short work. 2024, there is a short workings of 24,000. In year 2025 also, there is a short workings of 140,000 minus 120,000. Then you have the short workings of 20,000. Now, if you have, how much will be the actual royalty paid in year 2024? So the landlord cannot receive below the minimum rent. So the amount that will be paid to the landlord will be 140,000 in year 2024. So you have 140,000 as well. So in year 2025, landlord cannot receive below the minimum rent. So 140,000 will also be paid by the lessee to the landlord. So we have 140,000. In year 2026, so we have, there is excess short workings here. there is excess royalty, in year 2026. The excess of 30,000. Remember, the lessee has suffered 24,000, which can only be recovered within the next 2 years. The 24,000 losses suffered by the lessee in year 2024 will be recovered within the next 2 years, and the next 2 years is 2025, 2026. That means any portion of the 24,000 that cannot be recovered in year 2026 will constitute a loss to the lessee. Therefore, but in year 2026 now, we now have a surplus of 30,000. That means the 24,000 deficit, which has been suffered here, can be recovered. If they recover the 24,000, and in year 2025 also, the lessee suffer another loss of 20,000. That means this 24,000 will be recovered from 30,000, which is the difference between 170,000 and 140,000. If 24,000 is recovered, then you will still be left with 6,000 balance from that 30,000. This 6,000 will also be utilized as part of the amount that can be recovered from this 20,000. That means this 20,000 now, you will now be left with 14,000 from it. So the amount that will be recovered now, that is the short work is recouped in year 2026, will be the 30,000. The 30,000 comprises the 24,000 suffered in year 2024 and 6,000 from this 20,000. That means you'll be left with balance of 14,000 to be recovered in the next year or in the following year. Any portion of it that cannot be recovered, that is, if that 14,000 cannot be recovered in 2027, it will become a loss, a short working loss. That is the amount that cannot be recovered again. So how much will be the royalty paid? I've told you that the lessee cannot receive below the minimum rent. And remember, the excess of this 170,000 have only been used to recoup the amount of short workings which the lessee has suffered in the previous year. So the amount that will be paid will still be 140,000. That is the table showing the preliminary workings. After these preliminary workings, the next thing is the accounting entries in the books of the lessee. That is, we want to show the necessary accounts in the books of the lessee in line with the principles of double entry. Remember, everything is in line with the double entry principle. And the double entry principle states that for every debit entry, there must be a corresponding credit entry. Now, the first account, let's have the royalty payable account. Royalty in the ledgers, let me say in the ledgers of OJ Limited. Remember, OJ Limited is the lessee. So we want to open number one, royalty payable account. Royalty payable account. The debit side and the credit side. So amount is in dollar. So the first year is year 2022. 2022, 2022. So in the year 2022, now I have told you that royalty payable is an expenses. Being an expenses account, it will therefore have a debit balance. So we debit the royalty payables account and we credit the landlord account. So the amount to be debited to the royalty payable in year 2022 is 84,000. So we debit 84,000. We have the lessor. That is, the lessor is EZIKAN. EZIKAN is the lessor. So you credit EZIKAN account with 84,000 in the year 2022. That is December 31st. You credit and you debit the royalty payables account. Now let's open the EZIKAN account. EZIKAN account. EZIKAN account. EZIKAN is the lessor. So we have the lessor or the landlord account. So we have the first year, which is year 2022. 2022. So since the royalty payable has been debited with 84,000, therefore the landlord account, that is the EZIKAN's account, will be credited. So we have December 31st. We have royalty payable, and that amounted to 84,000. Then after 2022, the following year will be 2023. So 2023 now. 2023. So the amount of royalty payable in 2023 is 152,000. So you are going to debit the royalty payable account and you credit EZIKAN, that is the lessor account. December 31st, you have EZIKAN account, that is the lessor account. The amount is 152,000. So you credit EZIKAN account. December 31st, you have royalty payable, and that amounted to 152,000. 152,000. Then the year that follows is year 2024. 2024. In year 2024, December 31st, you have EZIKAN, that is the royalty payable. In year 2024 is 116,000. 116,000. So you credit the landlord account December 31st. So you have royalty payable, and that is 116,000. After 2024, the years that follow is 2025. 2025. So in the year 2025 now, 2025, December 31st, you have EZIKAN. EZIKAN is the lessor. And in year 2025, the royalty payable is 120,000. 120,000. So you credit EZIKAN account. 2025, December 31st. Royalty payable, and that amounted to 120,000. In year 2026, the year that follow, 2026. In year 2026, December 31st, you have EZIKAN account, and the royalty payable in year 2026 is 170,000. 170,000. You credit the landlord December 31st. Royalty payable, and that is 170,000. Now, remember, everything is in line with the double entry principles. We have posted the royalty or the actual royalty column. We've done with this column in our preliminary working table. Then the next column is the minimum rent. The minimum rent. After the minimum rent, okay, now let's post the royalty paid. The amount paid in each of the years is $140,000. So that is the amount paid in each of the years. Then in year 2023 now, I've told you that when the lessee pays, the lessee is going to credit his cash book. Cash book will be credited. The lessee is paying the lessor. That means the lessor is the receiver. That is, the landlord is the receiver. EZIKAN is the receiver. In this case, we are going to debit the receiver's account, which is EZIKAN, and the cash book of the lessee should be credited. Remember, all these entries are in the books of the lessee. So in this case, as at December, the date of payment, December 31st, we now have cash book. Cash book. The amount paid, which is 140. In 2023, 140,000 was paid to the lessor. December 31st, we have cash book. and that amounted to $140,000. In 2024, the same amount was paid. Cash book, and that is $140,000. In 2025, we have cash book, and that is $140,000. And in 2026, the same amount was paid. December 31st, we have cash book, and that is $140,000. Then the next item is the short workings. As at the end of the period, if you look at the table of our workings, we have 56,000 as our short workings. The amount by which the minimum rent exceeds the royalty payable. So we have the short workings of 56,000. 56,000. And the total is 140,000. 140,000. Here, we also have short workings recouped. December 31st, short workings recouped. Short workings recouped, and that amounted to 12,000. So if you sum it up, you have 152,000. 152,000. In 2024, you also have the short workings. December 31st, we have short workings of 24,000. If you sum it up, you have 140,000. 140,000. Then in 2025, we also have the short workings of 20,000. Short workings of 20,000. And if you sum it up, you have 140,000. 140,000 as the total. 140,000. In 2026, you have the short workings recouped. Short workings recouped of 30,000. Short workings recouped of 30,000. The total is 170,000. 170,000. 170,000. So that is the short workings recouped. So now, the next account is the short workings account. Now let's have the short workings account. Short workings recoverable account. Short workings recoverable account. So short workings recoverable account. The first year is year 2022. 2022. So if you go back to the landlord account was credited with short workings of 56,000. And remember the double entry principle. For every debit entry, there must be a corresponding credit entry. Since landlord account, that is EZIKAN account, has been credited with 56,000, the corresponding debit entry will be in the short workings account. So we have EZIKAN, December 31st, EZIKAN, and that amounted to 56,000. So you balance the account. Remember, this is an asset account. I've told you that short workings recoverable account is an asset account. As at December 31st, you have balance carried down, and that is 56,000. Then after 2022, the years that follows is 2023. 2023. So the balance carried down here will be brought down. Let's have January 1st, the first day of the following year. We have balance brought down, and that amounted to 56,000. In year 2023, you have the short workings recouped. The amount recouped from our short workings is $12,000. We have short workings recouped. So, which was debited to EZIKAN. So that means if you take a credit entry in the short workings account, December 31st, you have EZIKAN account. So we have $12,000. So that is 2023. So as at the end of that year, December 31st, so the difference between the two sides, you have it as balance carried down. The difference is 44,000. So we have 56,000 as the total. 56,000 as the total. After 2023, the year that follows is 2024. Now, this is the continuation of that account. That is the short workings recoverable account. The years that follow is 2024. 2024. The amount, the balance you have here is 44,000. And that is balance carried down. It will be brought down to the following year. So you have January 1st. January 1st, balance brought down. And that amounted to $44,000. Back to the landlord account. In the same year, 2024, you have short workings. You have short workings of 24,000. Short workings of 24,000 credited to EZIKAN account. That means that will take a debit entry here. December 31st. So we have balance, EZIKAN. And that amounted to 24,000. For every debit entry, there must be a corresponding credit entry. Now, if you go back to the table of our preliminary working, the 2024 here, you have short workings lapse. I've told you that the amount of short working that is lapse should be written up to the statement of profit or loss. So you have December 31st, the end of that year, you have income statement. That is the statement of profit or loss. And that is 44,000. The amount lapse is the amount that will be written off to the statement of profit or loss. So as at the end of the year, let's close the account. The total here is 68,000. 68,000. Then December 31st, you have balance carried down. If you subtract 44,000 from 68,000, you'll be left with 24,000. 24,000. The total still remains 68,000. After 2024, the year that follows is 2025. The year that follows 2024 is 2025. Now, let's have our 2025. 2025. The balance carried down here will be brought down. So we have January 1st, balance brought down, and the amount is 24,000. 24,000. Then back to the landlord account, that is the EZIKAN account. In 2025, you have the short workings of 20,000 credited to EZIKAN account. That will take a debit entry in the short workings recoverable account. So December 31st. December 31st, you have EZIKAN. And that amounted to 20,000. So if you add it up, if you sum it up, you have 24,000 plus 20,000. That will be 44,000. 44,000. So as at the end of the year, as at the end of that year, which is 2025, you close the account. December 31st, balance carried down. And that is 44,000. So 44,000. 44,000. After 2025, the years that follow is 2026. 2026. 2026. So, and the 2026 is the last year in question. 2026 is the last year. So the balance carried down here will be brought down. So January 1st, balance brought down. And that amounted to 44,000. 44,000. So in 2026, back to the landlord account, you have the short workings recouped or recoverable. Short workings recouped of 30,000. So since it takes a debit entry here, so it will receive a credit entry in short workings recoverable account. So December 31st, you have EZIKAN, and that amounted to 30,000. 30,000. So then the difference between the two sides, December 31st, you have balance carried down. The difference between 44,000 and 30,000 is 14,000. Total is 44,000. So 44,000 as a total. Then after 2026, you are going to bring down the balance to 2027. January 1, balance brought down, and that amounted to 14,000. The balance you have in your royalty payables account should be close to the income statement. That is, those balances should be close to the statement of profit or loss. You have December 31st, income statement, and we have 84,000. That should be close to income statement. Then in 2023, you have December 31st, income statement, and that amounted to 152,000. In 2024, the 116,000 should be close to income statement. December 31st, income statement. That is the statement of profit or loss. We have 116,000. In 2025, the 120,000 should be close to income statement. December 31st, income statement, and that amounted to 120,000. Finally, in 2026, the 170,000 should be close to income statement. December 31st, we have income statement, and that is 170,000. So this is the end of the part 1 of my lectures on royalty accounts. In part 2, I will examine the accounting for royalty in the books of the lessor. Thanks for watching.